In the previous video, we have identified two major types of adjusting entries. One will be for deferrals and the other will be for accruals. So in this video, we will look at several examples on how do we do the adjusting entries for deferrals. Okay, so like I've mentioned before, that deferrals are expenses or revenues that are recognized at a date later than the point when cash was originally exchanged. Okay, the cash has already been exchanged, but we recognize the revenue or expense at a much later date. Okay, so there are two types of deferrals. One is prepaid expenses, and the other is unearned revenues. Okay, prepaid expenses. Prepaid expenses, payment of cash that is recorded as an asset to show the service or benefit the company will receive in the future. When the company has paid out cash, okay, for an expenses, it will be considered as an asset. Okay, why it is considered as an asset? For example, you have paid your rent to stay in college from September until August next year. Okay, but you are still, for example, you are still in September the previous year. Okay, so you will when you pay your rent in September, you are expecting to receive the benefit of your payment across 1 year. So when you are expecting to receive benefit, that is called an asset. Okay, an asset is something that you expect to gain economic benefit from for a certain period of time in the future. Okay, so you have paid the cash, but then you will expect to receive the benefit of the expense for a certain period of time in the future. So prepayments often occur in regards to insurance, rent. Okay, I have given the example of rent. Insurance, similarly, when you pay for insurance, a very simple one is when you use a car. Every year you need to renew your insurance, but that insurance is for 1 year, so you pay your insurance in advance of 1 year. Okay, so you expect to receive the benefit from the insurance, which is the insurance coverage for the next period of 12 months. Okay, when you purchase supplies, when you purchase equipment, when you purchase supplies for your use in your office, you have not used the supplies, but you have paid for it in the beginning. Similarly, for advertising, you pay for 3 months of advertising, but then the advertising has not been done yet. Okay, and you buy or you purchase a building, and you will be using your building for 10 years. Okay, so you have made the payment, but then you will receive the benefit across 10 years. Okay, so this is a prepaid expense. So in prepaid expense, the expense will expire either with the passage of time or through use. Okay, what do you mean by passage of time? For example, you have your insurance. Okay, actually you don't use your insurance. Okay, insurance is a coverage for any calamity that could befall on you. But then it is more of a passage of time. So you pay your insurance for 12 months, and after that 12 months, the passage of time has been up. Okay, so it will expire. But some other prepaid expenses is through use. For example, you purchase supplies. Okay, you have office supplies, such as you have your printer, toner, you have your stationery. Okay, you have all these things, and when you use them up, then you will recognize that you have done your expenses. But for example, if you purchase a printer toner, but you have not used it for over 12 months, then it is still an asset to you, and you should not consider it as an expense. Okay, because you have not actually used those printer cartridge. Okay, So the adjusting entry here, when we say adjusting entry, is that when you have actually used up the expense. So for example, when you pay for insurance for 12 months, and that 12 months has passed, okay, has expired, then you need to do the adjusting entry, okay, because at the time when you pay your insurance, you will record it as an asset. Okay, you will credit your cash because you pay out with cash, but you will debit an asset account because you are expecting to receive benefit from the insurance. Okay, but then after the passage of time, after 12 months is up, you have used up the time period of the insurance, then you need to do the adjusting entry, which is to debit an expense account, because previously you don't have an expense account, or you have not recorded as expense, but after the time period has passed, you need to record it as an expense. Therefore, the adjusting entry is to increase or to debit an expense account. And because now you have the insurance has expired, you no longer expect to receive benefit from that insurance you have paid. Therefore, you need to decrease the asset account. Okay, because like I said, asset account is something that you expect to receive benefit in the future, but now the time is up, you are not expecting to receive any more benefit from the insurance that you have paid. Therefore, you need to decrease your asset account. Okay, so what happens here is that you will credit, or you will decrease the asset by crediting it, and the opposite side will be the increase in expense or debiting the expense. Okay, so let's see an example here, a practical example. Okay, so Pioneer Advertising purchased supplies costing 2,500 on October 5. Okay, so Pioneer Advertising purchased supplies 2,500 on October 5. Pioneer recorded the payment by increasing asset. Okay, so when Pioneer paid for the advertising, it will debit the asset supply, and this account shows a balance of 2,500 in October 31st trial balance, and the inventory account at the close of business on October 31st reveals that 1,000 of the supplies are still on hand. Okay, so Pioneer purchased supplies worth 2,500 on October 5. At the end of October 31st, they found that out of 2,500 that they bought, the remaining supplies is worth 1,000. 1,000 is still remaining. Therefore, they have actually spent how much? They have actually spent 1,500. Okay, 2,500. They bought what 2,500 worth. At the end, they have remaining 1,000. Therefore, they have actually spent during the month of October for 1,500. So that 1,500 needs to be adjusted. Okay. So on 31st of October, what they need to do is they need to debit supplies expense. Okay. They need to debit supplies expense because 1,500 worth of supplies they have actually used. And they need to credit supplies 1,500 to take out. They have actually in October 5 they have an asset of 2,500, a supply asset of 2,500, but then because they have used up 1,500, therefore we need to decrease the supplies by 1,500 by crediting the supplies by 1,500. Okay. So let's see an analysis of this basic analysis. Here the supplies expense is increased 1,500. Okay, after by the end of October, by October 31st, they have used up 1,500 supply. Therefore, there's an expense. An expense has increased by 1,500 and the asset decreased by 1,500 because they have used up the supply. The remaining is only 1,000. Therefore, they have used 1,500. So the effect of this analysis is on the accounting equation. Okay, so on the accounting equation, supply will decrease by 1,500, but the supplies expense will increase by 1,500. But of course, because expense is opposite of owner's equity, expense is something that will reduce owner's equity. Therefore, increase in supply expense means the reduction in owner's equity. Okay, so it will reduce owner's equity by 1,500. So then we do the debit and credit. Because we need to reduce supply by 1,500, therefore we credit our supply 1,500, and because we increase our supply expense, therefore we need to debit our supplies expense accounts by 1,500. So this is the journal entry. After we do the debit credit analysis, we do the journal entry. On October 31st, we debit supply expense 1,500 and we credit supplies 1,500. And then from this journal entry, we post to the account. So this is the supplies account. On October 5, we already have 2,500 when we purchase the supply. But then on October 31st, we do the adjustment that comes from here, credit supply 1,500. So after 31st October, the ending balance will be 1,000. We only have 1,000 left in our supply. And then for our supplies expense, after we do the adjustment, we have a debit on our supplies expense account by 1,500. Therefore, the balance of supplies expense at the end of October is 1,500. Okay, so that is the example of supplies. Okay, another example of prepaid expense will be insurance. Okay, on October 4, Pioneer Advertising paid $600 for a 1-year fire insurance policy. Coverage began on October 1st. Pioneer recorded the payment by increasing prepaid insurance. This account shows a balance of 600 in the October 31st trial balance. Insurance of 50, which is 600 divided by 12, expires each month. Okay, so let's see. Pioneer paid 600 for 1 year insurance coverage. Okay, they paid it on October 4. So at the end of October, they have used up 1/12. Okay, 1/12 of 600, which is 50. So 50 will need to be adjusted in the accounts. Okay, so how do we do the adjustment? We need to debit insurance expense because after 1 month, Pioneer has actually used up 1/12 of the 600 that they paid, which is $50. Okay, so we need to debit insurance expense by $50, and we need to credit prepaid insurance because at October 4, Pioneer paid $600, so $600 is a debit to an asset account. The asset account is called prepaid insurance because we are expecting to receive benefit from the prepaid insurance for 12 months. Okay, so but after 1 month, we have actually consumed the insurance. Okay, we have consumed it for 1 month. Therefore, we need to credit prepaid insurance to show that our prepaid insurance is only left for 11 months of benefit. Okay, so we credit prepaid insurance for $50. So to look at the analysis, the basic analysis that we do is that the expense insurance is increased by 50. Okay, at 31st October, there's an increase in insurance expense by 50, and the asset is reduced by 50 because although we have paid 600 at the beginning, but now 1 month has passed, therefore we need to deduct 1/12 out of 600. So that will decrease our prepaid insurance. So this will be the equation analysis. Similarly, as in the case of the supplies, we reduce our prepaid insurance by $50 on the asset side, and we increase our insurance expense, but that will reduce our owner's equity. So in terms of the debit and credit analysis, because we want to increase our insurance expense, then we debit our expense. And because we want to reduce our asset, therefore we credit our asset, which is called prepaid insurance, for $50. And this is the journal entry. On 31st October, we debit our insurance expense by 50, we credit our prepaid insurance by 50, and from there we do our posting to the accounts. Here in prepaid insurance, we already have 600 we paid for on October 4, but then we do adjustment for 50, and after 31st October we only have a balance of 550. We are expecting to get benefit from the insurance only for 550 because only 11 months left. We do the posting on our insurance expense account. We have a debit on our insurance expense for $50. So at the end of October 31st, we have a balance of $50 of insurance expense that should go into our adjusted trial balance. Okay. Another prepaid expense will be depreciation. Okay, depreciation, adjustment to prepaid expense will be depreciation. What is depreciation? Organizations purchase buildings, equipments, and motor vehicles, which are called assets. These are fixed assets that will give benefit to the company more than 1 year after the purchase. Okay, so when a company purchase a building, they would expect to get benefit from the building maybe 30 years, maybe 50 years, maybe 100 years. Maybe if they purchase motor vehicles, they are expecting to get benefit from the motor vehicle for 5 years at least. Okay, so when we purchase a motor vehicle for 5 years, then the benefit that we get will be across 5 years. But then every accounting period, we need to take into account that 1 year has passed. Therefore, we have get the benefit. We have used up 1 year of benefit from the motor vehicle. So that 1 year of benefit from the motor vehicle need to be adjusted. And in accounting, we use the term depreciation. Okay, to take into account the consumption of that fixed asset. Okay, so depreciation is allocating the cost of an asset to expense. Okay, we want to recognize the use of the asset as an expense. We use the term depreciation. Okay, depreciation does not attempt to report the actual change in the value. Okay, depreciation is not about the change in value of the asset, but it merely looks at the consumption of the asset across its useful life. Okay, so it is an allocation concept, not a valuation concept. We allocate the use of the asset across its useful life. Okay, so depreciation is an adjustment. Depreciation is an adjustment to a prepaid expense. Well, in this case, an adjustment to the purchase of fixed asset. Okay, so for example, for Pioneer Advertising, assume that depreciation on the equipment is $480 a year or $40 a month. Okay, let's assume they have purchased an equipment, and the equipment will be giving them benefit for a certain number of years, and after calculating the amount that they will use up, or the allocation for 1 year from the asset will be 480. Therefore, if we go on a monthly basis, it will be 40, which is 1/12 out of 480. Therefore, the recording is that depreciation expense. Okay, we record a depreciation expense. We have consumed the equipment for 1 month. Therefore, the consumption is called expense. It's called depreciation expense, and that is for 1 month. Therefore, it's $40 debit. And to credit, for fixed assets, we don't credit the asset account, but we create another account or contra account called accumulated depreciation. Okay, it is called accumulated depreciation. For we credit that accumulated depreciation account. Accumulated depreciation account is not the same as depreciation expense. Depreciation expense is an expense account that goes into our income statement. It will show that our income will be reduced through our expense. But the accumulated depreciation account is a contra asset account. What is a contra asset account? An asset account, we know, is something that appears in the balance sheet. It is a property that we have. But accumulated depreciation is a contra. It is a reduction from the asset. Okay, it is a reduction from the specific asset. Okay, it is a contra asset account. Okay, so let us see some the basic analysis. The expense, depreciation expense is increased by $40 because we have used up the equipment for 1 month. Therefore, it is $40. And we the expense is increased, but the accumulated depreciation is also increased. Okay, because the amount that we want to reduce from our asset is accumulated depreciation, and that has increased by 40. So the equation analysis is that because we use our asset, it will reduce our asset, and we reduce our asset by adding to our accumulated depreciation account. It is a contra account, which is opposite from asset. And then because we have made the expense, we reduce our owner's equity by adding the depreciation expense, which have a negative $40 impact on our owner's equity. And then we do the debit credit analysis. We do the debit on our depreciation expense account by $40, and we credit our accumulated depreciation equipment by $40. And this is the journal entry. On October 31st, we debit depreciation expense and we credit the accumulated depreciation for equipment $40. Okay, and this will be the effect of the journal entry on our accounts. On our equipment accounts, on October 2nd, we bought the equipment for $5,000, but the adjusting account will not change the equipment account, but it will have impact on the accumulated depreciation, which will, in effect, at the end, it will reduce the value of the equipment on our balance sheet. Okay, so we credit our accumulated depreciation equipment account for $40, and we debit our depreciation expense by $40. Therefore, our depreciation expense will have a balance of 40. Our accumulated depreciation equipment will have a balance of 40, but it will accumulate after every month. So after 12 months, we will expect that the balance will be 480 because it has all the adjustments for all of the 12 months. Now we only have adjustment for 1 month. Okay, so how do we show this depreciation? Okay, of course, the depreciation expense will go into the income statement. But what happens to the accumulated depreciation? We have mentioned that accumulated depreciation is a contra asset account. It is opposite to the asset account. It offsets the related asset account on the balance sheet. So the asset account itself will be shown on the balance sheet, but the accumulated depreciation account, which is the contra account to the asset, will also be shown on the balance sheet. Okay, so in balance sheet, we will show this in the box here. It will show equipment, the cost of the equipment. We will show the cost of the equipment as $5,000, but we will also show the accumulated depreciation for $40. So the balance $4,960. This is the expected benefit that we will receive from the asset in the future. We have used up $40. So the expected benefit is 4,960. This is called the book value. The book value is the difference between the cost of any depreciation asset and its accumulated depreciation. So the book value for equipment is 4,960 because the cost is 5,000, but 1 month has passed since its purchase. Therefore, the remaining value will be 4,960. Okay, so as a summary, the accounting for prepaid expense is that okay. So example of prepaid expense will be insurance, supplies, advertising, rent, and depreciation. Just now we shown insurance, supplies, and depreciation. The reason for the adjustment is that prepaid expenses recorded in asset accounts have been used. We have purchased some asset, and at the end of certain period we have used up some of those assets. Therefore, we need to do the adjustment. So before we do the adjustment entry, the asset is overstated. Why is it overstated? Because we have purchased the asset and we have used up some of it, but our asset account is still showing the full amount. Okay, and the expense is understated because we have used up some of the asset, but we have not done any recognition on the expense. That is why the expense is understated. Therefore, we need to do the adjusting entries. So the adjusting entries will repair this inaccuracy. Okay, to do the adjusting entry, we debit the expense because our expense have been understated. We need to increase it. Therefore, we debit our expense. And our assets are overstated. Therefore, we need to reduce our asset. We reduce our asset by crediting the asset or crediting the contra asset in the case of depreciation. Okay. Okay. The second part of the deferral adjustment will be the unearned revenues. We have shown before deferrals that comes because of prepaid expense, but the other type of deferral is unearned revenue. We have not done the work, but then our customer have paid some money for our work which has not been done. So that is called unearned revenues. We receive of cash that is recorded as a liability because the service has not been performed. So when our customer pays us money for service that we have not done, then it is a liability because we should not have received that money. But when we receive that money, we are all obligated, we are obliged to render the service to our client. So therefore, it is a liability because we owe our client some services. Okay, so that is called a liability. We receive the cash before our revenue is recorded. So examples of unearned revenues often occur in regards to rent. Rent in the sense of we provide rental services to our client. Okay. Airline tickets, okay. If we are a big airline, we are Air Asia, and our customer has bought the airline ticket, but then they have not flown on the flight because the flight is in the future. Therefore, it is considered as an unearned revenue. We have not rendered the flight service, but we have already received the money from our clients. So this is an unearned revenue. Other examples include magazine subscription. Okay, maybe our company provides, we distribute magazines, and our clients will pay for magazine subscription. They pay at the early time, but we will give out the magazine across 1 year. So this is an unearned revenue for us. Okay. So in unearned revenues, adjusting entry is made to record the revenue for service performed during the period and to show the liability that remains at the end of the period. Okay. So at the time of the recording, when the transaction occur, when we receive money from our client, we will debit cash because we receive cash, but then we will credit our liability. Okay, but at the end of certain period, some part of the service could have been rendered. We could have given out some of the service. Therefore, we need to recognize that some of the revenue has actually happened. Therefore, we need to recognize our revenue. So to do this recognition of our revenue, we need to decrease our liability because we have done some of our part. Therefore, we are not owing the client as much as before. Okay, so we need to decrease our liability account and we need to increase our revenue account because now we have done some part of the work. Therefore, we need to recognize that as a revenue. So to recognize that as a revenue, we need to increase the revenue account, which is by crediting that account. Okay, so unearned revenues, when there are some revenues that have been done that we want to recognize, therefore we will debit our liability account and we will credit our revenue account. This is when some of the unearned revenue has been how some of it has been done. Okay, so let us look at an illustration. Pioneer Advertising received $1,000 from on October 2 from RNOX for advertising services expected to be completed by December 31st. Unearned service revenue shows a balance of 1,200, of course, in the October 31st trial balance. Analysis reveals that the company has performed $400 of services in October. Okay, so RNOX, the client, has paid 1,200 for marketing, for advertising services that will run across three months. Okay, from October until December, which is 3 months of advertising. Pioneer Advertise will run the advertising service for 3 months. So at the end of 31st October, 1 month of advertising has been done. Therefore, we need to recognize 1 month of revenue. So 1 month of revenue equals $400. Okay, so because the advertising cost is 1,200 for 3 months, and 1 month has passed. Therefore, 400 is should be recognized as revenue in October. So when we want to recognize 400 as a revenue in October, we need to debit the unearned service revenue. So unearned service revenue is a liability account. On October 2nd, we recorded the receipt of cash as a liability because we have not rendered the service, but we received the money. Therefore, we owe our client some service. Therefore, it is a liability account. So, but after 1 month, we have actually done some of the work. Therefore, we need to reduce the owing that we have on our customer. Therefore, we reduce by 400 by debiting our unearned service revenue liability account. And on the other side, we need to recognize this as a revenue because we have rendered 1 month of service. Therefore, we credit our service revenue account by 400. Okay, to look at the analysis of the adjustment, the liability unearned service revenue is decreased by 400 because we have rendered part of the service of the value of 400. Therefore, we reduce our liability. We do not owe them as much as before. And the revenue is increased by 400 because we have done the service. We need to increase our revenue. The equation analysis that we had our liability, but we want to reduce our liability. Therefore, we minus our unearned service revenue liability account. And then we on the other hand, because we receive because we recognize our revenue is something that will increase our owner's equity. Therefore, we add 400. So if we look at the equation analysis, we minus 400 here, but we plus 400 here. Therefore, our equation is still balanced. So in terms of the debit credit analysis, we debit our unearned service revenue by 400 because we want to decrease our liability, and we credit our service revenue by 400 because we want to increase our revenue. In the journal entry that we do for this is that on October 1st, we debit our unearned service revenue by 400 and we credit our service revenue by 400. And then we transfer this, we do the posting to our accounts. On our unearned service revenue, we have a debit of 400. We originally had 1,200. We have a debit of 400. Our remaining unearned service revenue balance at 31st October is only $800. So we only owe our client now $800 worth of service. And then we credit our service revenue. Let's say on October 3, we have 10,000 of service revenue coming from other services. And then we add 400. Now our service revenue will be 10,400. Okay, so to summarize about unearned revenue, examples of unearned revenue include rent, magazine subscription, customer deposit for future service. And the reason for the adjustment is that unearned revenues recorded in liability accounts are now recognized as revenue for services performed. Okay, so at the end of certain period, the amount that we originally recognized as a liability, some of it have been satisfied. We have done the work for some of the liability, therefore we need to do the adjustment in order for us to actually recognize that there's a revenue going on. Okay, before we have done the adjustment, okay, at the time that we have conducted some of the service but we have not done the adjustment, the liability account will be overstated. Okay, because we have originally recorded as a liability the unearned service revenue, we have recorded as a liability, but then because some of the work has been done, the liability should go down. But then if we have not done the adjustment, our liability will be overstated, will be more than what it is supposed to be. The revenue will be understated because we should be getting, we should recognize it as a revenue, but we have not done so in the account. Therefore, our revenue is understated. It will show that our income is less than it is supposed to, and then it actually is. Okay, so in order to rectify this, we need to do the adjusting entry by debiting the liability, which is to reduce our liability, and also to credit our revenue, which is to increase our revenue. So that's the summary of the unearned revenues.